Welcome to Iron Financial. This is where we forge stronger portfolios by taking the market's pretty stories and putting them through a white-hot stress test. And today, we're targeting a massive disconnect. On one hand, you have the overall market. It's this gleaming architectural blueprint priced for nothing less than absolute perfection. It's a tower of optimism reaching into the clouds.
And then on the other hand, you have the ground-level reality of individual companies. You know, the actual nuts, the bolts, the rebar that's supposed to hold that entire massive structure up. We're here to find out what happens when that perfect, glossy blueprint gets hit by the cold, hard reality of economic gravity.
All right, let's get right into the framework itself. This data from LSEG, well, it lays it out in stark black and white. The 12-month forward price-to-earnings ratio for U.S. stocks is sitting at a staggering 22.7. Now, to really understand what that means, you have to compare it to the 10-year historical average, which is down at 15.6. So we're not just talking about a minor stretch here. This is a skyscraper of expectations being built on what might be very questionable ground. The market is priced for flawless execution, clear skies, and absolutely zero mistakes. And here's the real kicker. These are valuation levels we haven't seen since the absolute tippy top of the dot-com bubble. The market's blueprint is making a huge assumption that every single company is built like a fortress, able to withstand just about any pressure thrown at it.
So the whole bet is that every company deserves this kind of premium valuation, that this rising tide is lifting all the boats, even the ones that might already have some serious holes in the hull.
Exactly. From 30,000 feet, that blueprint looks fantastic. It's beautiful. But we're down here on the ground, we've got our hard hats on, and we're inspecting the welds in the concrete mix. So the really crucial question for any serious investor has to be this one. Is the foundation of every single company truly strong enough to support this massive towering structure? Or are we, as a market, just collectively ignoring deep, fundamental cracks in the bedrock, cracks that could threaten the integrity of the entire building? That's the heavy lifting we're here to do today. And here is our own no-nonsense blueprint for today's deep dive. First, we are going to examine the market's so-called solid foundation, the whole bull case for 2026. Then, we're going to get our hands dirty and find the structural flaws in our case study for today, Jack in the Box. After we've identified the problems, we'll take a hard look at management's supposed reinforcement plan. Then, we'll run our own stress test on that plan. And finally, we will deliver the verdict. Is this stock an opportunity to build real wealth, or is it a value trap just waiting to collapse? Okay, first things first. Let's really look at the market's master plan. This is the optimistic blueprint, the beautiful architectural rendering from LSEG's Outlook that's being passed around to justify those sky-high valuations we just looked at. This is the story the bulls are telling themselves. So the bull case really rests on several key pillars. They're betting on resilient earnings growth that's going to broaden out beyond just that handful of mega-cap tech stocks that have been doing all the work. They expect profit margins, which, by the way, are already near historic highs, to just stay there. AI is the new high-strength alloy in this whole construction project, promising this huge wave of productivity and cost-cutting.
And of course, you've got the Federal Reserve, who's been cast as this friendly construction foreman who everyone expects to just show up with 2 or maybe even 3 rate cuts to keep the whole project humming along and make sure borrowing costs stay nice and low.
Precisely. And it all culminates in this big, beautiful forecast for S&P 500 earnings to grow by a massive 15.5%. You know, on paper, this foundation looks like it's been poured from solid granite. But here's the thing. A blueprint is just a theory. And here at Iron Financial, we test theories with intense pressure. To see if this beautiful design can actually withstand real-world force, we have to find a potential weak point and apply that pressure directly. And that brings us to our case study, Jack in the Box. This is the moment where we stop admiring the artist's rendering and we actually start kicking the tires. Hard. So let's meet our subject. We've got Jack in the Box, ticker JACK, along with its other major brand, Del Taco. I mean, these are household names in the quick service restaurant industry. They operate in a space that really should be a perfect example of a company benefiting from that resilient consumer the market's blueprint is counting on. People are still eating out, right? So is it working?
Well, that's the big question, isn't it? Let's put them under the microscope and start checking the integrity of their financial structure.
And the very first thing we find when we start digging is this number, negative $827.1 million. I just want to let that number hang in the air for a second. This is not a quarterly loss. This is not some weird non-cash one-time write-down. This number, pulled directly from their latest 10Q filing with the SEC, is their total stockholders' deficit. It is a massive, gaping structural void right in the middle of the company's financial foundation. And here's exactly how they arrive at that alarming figure. The math is as simple as it is absolutely brutal. Total assets, that's everything the company owns, comes to about $2.8 billion. But then look at the other side. Total liabilities, everything it owes, is over $3.6 billion. The company owes nearly $1 billion more than the combined value of all of its assets.
Wow. So to put in really plain terms, if they decided to sell off every single restaurant, every piece of kitchen equipment, every scrap of intellectual property they own, they would still be almost $1 billion in the hole. That's not a small leak we're talking about. The whole ship is taking on water.
And just look at the anchor that's pulling it down, almost $1.7 billion in long-term debt. This is an immense, crushing weight on the company's structure, a load that makes it incredibly vulnerable to even the smallest economic tremor. And you can see that pressure is causing visible, systemic damage. This isn't just some theoretical balance sheet problem anymore. It's showing up at the cash register, day in and day out. System-wide same-store sales fell by a shocking 6.7%. What that means is their established restaurants, the very core of their business, are bringing in significantly less money than they were before.
And it's a nasty double whammy. Just look at the restaurant-level margin. This number is the core profitability of their actual operations, and it has completely crumbled, going from a pretty healthy 23.2% all the way down to 16.1%. This tells you they're being squeezed from both ends. Fewer customers are even walking in the door, and it's costing them substantially more money to serve the ones who do. The stress fractures are starting to appear everywhere.
Okay, hold on a second. The numbers, they paint a really grim picture. There's absolutely no doubt about that. Based on that data alone, this building looks like it should be condemned. But the construction crew on site, the management team is out there telling everyone to stay calm. They're telling the market they have a plan, that they're reinforcing all the weak spots, and that the structure is going to hold. So before we completely write it off, let's at least hear their side of the story. But just look at the sheer confidence here. Despite that collapse in sales we just saw, despite the margin compression, and let's not forget, despite that horrific balance sheet, management stood firm. They reiterated their full-year guidance. Now, is this a sign of some true underlying strength that they see that we don't? Are they actually confident that the patches they're applying are really going to hold?
Or is it just pure hubris? Is it a management team that's simply refusing to acknowledge the cracks that are plain for everyone else to see? Sticking to a forecast in the face of rapidly deteriorating data can be either heroic or delusional. The numbers will eventually tell us which one it is.
And this isn't just talk. This is straight from their own investor presentation. The message to their shareholders is crystal clear and direct. And during these engagements, he offered no changes to our strategy. They are doubling down. They truly believe the blueprint they are currently working from is the right one. They are not going back to the drawing board. They're telling investors flat out that their current plan for reinforcement is more than enough to navigate this incredibly tough environment. And, to be fair, you have to admit the crew they've assembled, it looks pretty impressive on paper. The CEO, Lance Tucker, has over 2 decades in corporate finance. The board is absolutely stacked with heavy hitters from major consumer brands like Starbucks, Lululemon, and Darden Restaurants, which is the parent company of Olive Garden.
It's a valid point. These are not rookies. This is a team of seasoned executives who have navigated tough markets before. The entire bull case for the stock right now rests on the belief that this experienced crew knows exactly how to patch these holes and steer a heavily indebted company through a significant economic storm.
Experience is absolutely critical, but experience cannot change the weather. Now we get to the real stress test. This is the part where management's confident projections and their supposed reinforcement plans collide with the harsh, unforgiving reality of the economic environment. A great crew is useless if the storm is just too strong for the ship they're sailing. And here is that storm, making landfall. This quote, from the company's own earnings call, is devastatingly honest. Beef is definitely the most impactful one, actually came in a little higher than we had anticipated. Think about that. This isn't some complex financial instrument. This is the price of ground beef for their burgers. It's a real-world, tangible headwind that is slamming right into their cost structure. For them, commodity inflation isn't just some line on a spreadsheet. It's a wrecking ball hitting their profitability directly and, more importantly, unpredictably. And even the CEO, Lance Tucker himself, has to acknowledge the impact this is having on the ground. He says it plainly, the four-wall margins are not where they need to be. He's talking about the profitability of his franchisees, the individual small business owners who are the actual pillars holding up the entire Jack in the Box brand. And this forces us to ask the hard question. Is this just a temporary squall, or is the fundamental business model, which really relies on these franchisees to absorb rising costs, simply flawed for this kind of economic climate? Because when the people who are actually running your stores can't make money, your entire system is at risk of collapse. And the company itself gives us the long-range weather forecast, and that forecast is for more bad weather ahead. They state very clearly that they do not expect beef prices, which they just named as their single biggest commodity headwind, to ease up and become a tailwind for at least the next year, maybe even a year and a half.
So this isn't some temporary problem they can just patch over and pray for some relief. No. This is a sustained, high-pressure system that's bearing down on a corporate structure that, as we've already seen, is showing severe signs of financial distress.
So that brings us to the final inspection. We have seen the market's gleaming, optimistic blueprint. We've taken one of its core components, Jack in the Box, and we've subjected it to an absolutely brutal stress test. We've examined the deep structural flaws, and we have weighed them against management's reinforcement plan. Now, it's time to deliver the verdict. For an investor, is this blueprint an opportunity, or is it a trap? All right, let's lay out the final blueprint, side by side. The bull case, the argument for an opportunity here, it rests almost entirely on faith. It's faith that management is right to reiterate its guidance. It's faith in an experienced leadership team that's seen tough times before. The bull would argue that the brand is strong enough to endure, and that maybe, just maybe, these macro headwinds will ease up and give them the breathing room they so desperately need. But the bear case, the trap, is not built on faith. It's built on the cold, hard steel of the numbers we have just reviewed. A staggering stockholders' deficit of nearly $1 billion. Severe, undeniable margin compression. Negative same-store sales that show a clear decline in customer traffic, and a persistent, named commodity inflation that management themselves admit isn't going away anytime soon. The evidence for the trap is quantitative, and it's happening right now. The case for the opportunity is qualitative, and is based on hope for the future. So, here it is, the iron financial verdict. Jack in the Box is a corporate structure under immense and prolonged pressure, being propped up by a very high-risk reinforcement plan that relies far more on hope than on any hard evidence. The foundation, that balance sheet, is not just cracked, it is fundamentally compromised. Management's confidence and their current strategy are the patches they're applying, but against the sustained force of these economic headwinds, those patches may not be nearly strong enough to prevent a total structural failure. The risk of permanent capital loss here is, in our view, substantial. Which leaves you, the investor, with the final piece of heavy lifting. You have to decide, is management's public confidence the sign of some brilliant turnaround strategy that the rest of us just can't see yet? Are they truly the seasoned crew that can navigate any storm? Or are they just hammering loudly on the walls to distract everyone from the sound of a foundation that is crumbling beneath their feet? That is the multi-million-dollar question you have to answer before putting your capital to work.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.